Welcome back. Let's take a look at the numbers on the market. Starting in Asia, Asian shares extended gains today as a combination of stabilizing Chinese markets, a rebounding oil price and solid US consumption data prompted investors to look for bargains after the terrible week on the markets last week. Japanese stocks rose slightly in choppy trade. The Nikkei share average ending up 0.2%. Hong Kong shares extended their gains, led by energy stocks. The Hang Seng Index rose by 1.1%. Mainland Chinese stocks extended their rebound today, closing at a 3-week high. Investors also gained confidence from upbeat comments from China's premier, who hinted of fresh stimulus if the economy slowed further, and record-smashing loan data in January. The Shanghai Composite Index jumped by 3.3%. Very strong. US markets were closed yesterday, of course, for the President's Day holiday. Well, in Europe, markets slightly down, and the JSE also down about 0.6%. So we're not following that very positive trend that started in Asia, and it seems like markets are looking for direction. Let's take a look at your main financial indicators. Well, let's get some analysis now. I'm joined by Owen and Korma from Inkunzi Wealth. Great to have you with us again, Owen.
Thank you.
So markets looking for a bit of direction. The rand looking a little bit stronger, but the JSE down. Is this all about Asia? Bad data coming out, but signs that maybe the governments will intervene. So it's kind of bad news and good news at the same time.
Well, the odd thing is that I think everyone who has been long the market is actually very relieved about what has happened the past 3 odd days, because you've seen the JSE rally by about 2.5% last week Friday, and then yesterday it was up about 2.4%. So in a short space of time, in about 48 hours literally, we saw the markets recover 5%, which is which takes us back to a position where the JSE had been down 7% year to date. So we've recovered 5%, so it's a good move. We're down 0.6% today, and I think it's okay. It's a little bit of a breather. We don't necessarily have to follow the Japanese market trends per se. I really think we're still in a good position relative to where we were 2 weeks ago.
Okay, so we're basically starting the year again, basically.
Yes, I mean, exactly. So we're essentially down now about between 1.8 and 2% year to date, which is better than being down now at 7%. But you know what, Francis? Volatility remains extremely huge in the market. You see a stock like Anglo American would do 7% today, it'll be up 11% the next. Counters in the mining space have really been under the spotlight significantly, and they've staged quite a bit of a decent recovery, with some of them actually rallying by close to 80% year to date. If you look at a counter like Exxaro, when we came into the year, it was 42 bucks. It's trading now at about 60, having coming back from 72 just a few days ago. But volatility remains very big. You had ArcelorMittal yesterday up 28%. It's quite hectic out there.
Let's talk about Anglo American, because this is a company, part of it is De Beers, once had a monopoly on the diamond trade. It's fallen so far from grace already. After results now, last I looked, down more than 6%. But given its strength on the market, can that move the market, or is it already so diminished in terms of influence?
Unfortunately, that's the case, Francis. These stocks used to dominate the market in terms of size. It used to be Billiton and Anglo American and a few other counters, in the mining space. But now you'll find your NASPAs, your SABs, your British American Tobacco, and you've got InBev as well. And you'll find MTN and Richmond's are now the biggest counters on the exchange. So these things, whereas previously there would be about 50% of the JSE, now we'll be lucky to get them at 20% of the JSE in terms of the market cap. There's been quite a lot of growth in other areas. You've seen the property stocks move from about 40 billion a few years ago to 400 billion. So now Anglo American is really now merely a shadow of its former glory self. It used to trade at about 350 odd rands. and it's trading right now at about 85 odd bucks, having been trading at 54. So tough times out there, and I think that it's also a combination. Today's performance is a combination of the numbers and the fact that the market is generally pulling back in the resources space. The CEO there is indicating they'll continue to streamline the business into 3 key segments, and hopefully they'll manage to save some cash. We know they're already undergoing a scheme to create 85,000 redundancies globally in the business, which is quite unfortunate. But when times are lean, you have to create a lean sheep as well.
And basically, like you said, so they're going to focus on 3 things: diamonds, platinum, and copper, dumping their stake in Kumba iron ore. Was that expected?
No, look, I mean, we thought they would. They have no choice, actually, and they've had no choice for a long time. Instead of getting rid of some of the assets that they've had, which have been a big drain. You know, they've been looking to streamline as well some of their platinum mines, and I think getting rid of Kumba is testament of what has happened to this market. Kumba actually used to pay Anglo American and a few other shareholders in Kumba a dividend of about 43 bucks. But now Kumba has just recently been trading at 30 bucks, you know, and Kumba was trading at more than 400 bucks or at some point. You know, so it's definitely a sign that there's been a lot of depression in the iron ore space because of the slowdown in China.
For people who don't follow mining news day to day, can you give us a sweep of what has gone wrong with this company that, like you say, was once so big and then announced these, it's been called eye-watering job cuts last year, and enforcing that with profits down and being cut to junk status yesterday?
No, it's a matter of when things are going good, Francis, they are going really good, you know. But when they turn sour, then it's a total reversal of that. You see, Anglos used to be one of the biggest miners, basically, in the world. So they used to export stuff to every other country, even before China was at the forefront of leading global growth about 15 years ago. But unfortunately, they heavily invested in their mines, expecting that they'll continue to be able to send stuff through to China. So too did the other miners. You saw Billiton cut down their production capacities and pull back on some of their projects like Olympus Dam in Australia, which was tens of billions of dollars. And you could see that the guys can sense that China is not going to continue to sustain big levels of demand of iron ore, copper, and all the other stuff that these miners dig out of the ground. And for that reason, these companies actually basically started losing out on great volumes in China. They have big projects to take stuff out of the ground, but they don't have anywhere to send it to. You know, their orders started falling, and so too the values of their revenue started coming off, as well as the valuation of these businesses. So a stock like Impala Platinum that we once valued at about 200 rands, trading now at 33 bucks, definitely still a reflection of the trying times in the space. But what you have seen is a recovery, like I said, in the past in the past month. There's been a decent recovery. But
nowhere where they were.
Absolutely
and like
not.
you say, still all dressed up with nowhere to go, and,
exactly.
and they're shedding. All right, let's move to something else. A report from Moody's today saying the slowdown could be even worse. They're predicting 0.5% growth, but they've mentioned the word, the possibility of a recession. They're also talking about inflation and the fact that our interest rate hikes may come thicker and faster than we thought. Are they describing an economy in stagflation, that horrible word that everyone wants to avoid?
Yeah, look, there's definitely no growth, but I think that based on the numbers, we continue to see the trajectory or the direction in which the growth is going is actually negative. I don't know if it will be stagflation. So I think there's a bigger risk that we could actually see a negative growth in the coming several quarters, not necessarily next quarter or next 2 quarters, but you're starting to see people scale back South Africa's growth by GDP from 1% or to 0.8%, and now these guys talking about 0.5%. And I think actually the chances of the interest rates going up in the country still exist. We're calling for another 50 basis points rate increase in the year. So we think the governor will probably wait maybe for another 3 months, and then he'll give us another maybe 25. Because I think he did the right thing by increasing interest rate by 50 basis points. And if you look at the markets that are supposed to be directly affected by the rate hike, it hasn't been a very big impact. You would normally see that in the bond markets. You would normally see that in the property stocks, but that hasn't. Those stocks actually have been fairly stable, and I think there is still room in the market to take high interest rates because we're coming from historically low interest rate environments. But unfortunately, in terms of the growth in the country's GDP, we're still tied to the proverbial giant from the East, China. And if things don't turn around quite soon there for us, I do feel that, you know, it'll be a fallacy to expect anything aggressive in terms of growth in the country.
So that giant is sitting on us, basically. Thank you for your analysis, Owen Nkomo from Nkunzi. And that's a wrap of your market news for now.